I do things differently. Some investors like that, some do not. I like to tell investors, you're not my first priority. Normally, investors don't like hearing that, but it's true. They don't want to tell investors no. Or I tell investors no all the time. It completely wiped me out. I was paralyzed from my eyes down completely. So I couldn't breathe, talk, nothing. I became paralyzed overnight. I was hooked to life support, quadriplegic. Literally was like a light switch. I was fine one moment, then all of a sudden my legs stopped working. I got out of the hospital at 6 o'clock at night. The next day I went to work in my wheelchair for all of 20 minutes, and then I was passed out. I'm not an ATM. And I think investors got spoiled and they started to think that they should get distributions every quarter. And whenever somebody says that, I says,
my co-host, I keep forgetting to say that,
right.
my co-host of Drunk Real Estate. Anyway, for those of you who don't know, AJ is I'm going to start calling you guys sort of master syndicator, somebody who's like been syndicating for a while, has built a huge company. Most folks here, 75% of the real estate syndicator community, I would say, is actually, as you can imagine, is mostly multifamily. So I want to talk about self-storage for sure, but I definitely want to talk about how you built your businesses, because you've done a really nice job of scaling the syndication business. You've built multiple businesses. So I definitely want to talk about that. I want to talk about how, who you needed to become in order to get where you are today. I definitely want to talk about your private jets for sure. But first of all, I wanted to start off by your story, because you and I have a very, very similar story. And I wrote a chapter in a book about my ordeal, almost dying, having an autoimmune disease. And then I read your story, and I'm like, my story looks like a freaking walk in the park after hearing your story. So let's start there, my friend. Let's start with what you were doing before you got into self-storage, and then walk me through the story so people can get a little bit of an idea of how you got here.
Yeah, absolutely. I come from an insurance background. I did group medical benefits. We worked with seller financing deals, and I did what is known now as a roll-up model. We didn't call it that, but I was doing that in insurance, and I thought that storage was ripe for it early 2000s. And so we started to look at storage as an option, and we started to play in the space. At the time, the self-storage industry was nothing. Nobody talked about it. It was actually very much looked down upon. People didn't understand why us doing these benefit brokerage things. They're like, what are you doing? You're like slumlords now. And we're like, no, there's huge potential in this. And we really believed in it, but it was really looked down upon. And we started doing that because a way to diversify really our income off of this other side, because that was all worked earned income, right? It was like, we made money by selling, because we had clients and we had managed that. And so I lovingly referred to it as the treadmill. It was a beautiful treadmill, and we ran fast and it was successful, but we knew if we stopped running, it was over, game over. And that's essentially what happened to me. My treadmill stopped. I became paralyzed overnight. I was hooked to life support, quadriplegic. I just had our fourth. I didn't. My wife had our fourth child. I was there for moral support, and he was 4 months old. That's it, and it literally was like a light switch. I was fine one moment, then all of a sudden my legs stopped working, and then we couldn't figure out what was going on. And within 2-3 days, I was put on tubes, and that's where I stayed for months. I lost my job. I'd sold our brokerage firm to a big national one, which then I'd worked running that. They let me go in the hospital because they didn't know if there was even a checkout date. So from there, I was released out of the hospital to go home paralyzed and lie in bed. About 4 months afterwards, the insurance company kicked me out, and I went home and lied in a bed, and my wife took care of me, and my kids took care of me in bed. So we'd lost my job, and we'd lost, obviously, my way of living had been eradicated.
What year was this, AJ? What year was this?
This was 6 years ago, over 6 years ago now. And I was told at the time I was one of the most serious cases they'd ever seen. I'd been after 2 months on tubes, your recovery odds are just like nothing. It starts to crater. So after being in therapy for a few years, they eventually told me to, after over 2 years, they said, you can go home, but you're never, like, I was at least able to walk, but I had to use equipment. I had braces, I had arm things I had to use. And they were like, you're never going to walk again. So, you don't need to come here. Just keep taking your meds and go home. And so I love the self-storage industry. And because I say it saved our financial life, meaning the fact that I had this passive income coming in, and we had this other company that we'd done, and I was able to live. I was able to, like, take care of myself. My wife didn't have to ditch me, the kids, we didn't lose the house. We didn't, it was a big deal. And, we were really good. And what we did, we were building and buying. And I actually, after I got out of the hospital, the next day, I got out of the hospital at 6:00 at night. And the next day I went in to work in my wheelchair for all of 20 minutes. And then I was passed out. They had to take me away, but I was like, I'm not going to stop, so I started 3 companies out of my wheelchair, and sold one of it for multi-millions, and kept the other 2 and still running them. And that's what I've been doing for the last 6+ years now since that happened.
Where was your passive income coming from? Was it like self-storage, or was it other real estate?
It was all storage. Yep.
Got it. Yeah. Because you were, what was the name of I always mispronounce. You had what's the name of
It's called Guillain-Barré.
Yeah.
And it's a French word. It's your white blood cells attack your nervous system. And I was in the top percentile of Guillain-Barré patients, like ever. So it was, I got it good, really, really bad. I guess you don't get it. It's not like you catch it, but it's an autoimmune trigger.
Yeah.
And it completely wiped me out. I was paralyzed from my eyes down completely. So I couldn't breathe, talk, nothing.
Yeah, I actually mentioned the waist down on the post today, but then I'm like, nope, it was actually, I thought it was from the neck down. I didn't even realize it was from the eyes down. That's great. So you could move your eyes, but you couldn't, that was all you could move.
Yeah, I could only see towards the end of my bed, and then I could like try to move my head kind of around. I was totally aware of everything that was going on, but I'd communicate through blinking, and they would have these plastic sheets, which they'd hold up, and I'd try to move my eyes towards the picture on the plastic sheets. And that's how we communicated.
That's amazing, my friend. And then since then, tell us a little bit about where you are today in terms of, because I kept telling people you have 2, is it 2 8-figure? I know you have, I think, 4 businesses.
Yeah.
And 2 of them are 8-figure businesses.
Yeah. So one is right now we have right around probably $500 million in assets. And then the other one is, I mean, it's got to be over 150 right now. That's a tech company. And then I have a handful of other ones that are all $1 million plus ones as well.
And are these all connected to do they somehow connect to the self-storage business? It's all
Yep.
sort of integrated?
It's my ecosystem that I built out. And so it's an vertically integrated prop management company that incorporates our entire tech stack, everything. So software, all of it, we took on everything and built it ourselves.
Yeah, that's amazing. Well, let's talk about the tech company, because I know you're a big believer in tech, and I know you use tech a lot in your self-storage business. Talk a little bit about how you're using the tech in self-storage, and whether this is something that other asset classes could also use, and like multifamily or mobile home parks, or is it really limited to self-storage because of the uniqueness of self-storage?
So, it's interesting, because one of the things that was surprising to me was how, like, first of all, real estate is behind. Like, it just always has been, right? You have all these other industries that have been on the forefront of using technology, and real estate's core value doesn't derive from optimization. It derives from leverage, location, and time, right? And that's how it's perceived, at least. Now, that is not how storage works. I call storage, it is a business, and it's a business that's overlaid on a real estate asset. So we have people coming in every single day. We do things like dynamic pricing, revenue management, just like hotels and airlines do. But a lot of people didn't understand that. And so when we started doing those things, that was very new. People in storage, it was actually the opposite. Storage was viewed as like a land hold. And they were just like, fill people in, get people in, and then just, you don't do anything. It was about actually optimizing, doing less. And so when we came in, we were like, no, we want to do more, because we believed that there was you could drive revenues. And I think a lot more people today are seeing in most real estate asset classes that there is so much more you can do to optimize revenue. The more units per location and the shorter the contracts, the more it's maximized, right? If you have a triple net lease on a commercial and it's one unit and that lease goes out 10 years, there's nothing really to do, right? So a large commercial, large industrial and everything, no, there's not a whole lot that you can do. There's other things that we look at maybe that technology can do. But once you get into units, servicing, and all sorts of things like that, technology is a big part of it. I think when you get into large, even commercial, the way that they incorporate and they position their offerings for their tenants, I think now location, like your online location, is just as important as your physical location. It's because people don't go drive around looking for a place, right? They say, hey, I need shoes. Where do I go? Hey, I need something to eat. Where do I go? I need an apartment to rent. Where do I go? I need a hotel. I need a storage unit. I need whatever it is. And this tells them where to go. That's it. We don't go find it. Our little box tells us what to do, and then we do it. And so it's, that a lot of people, I think, just forgot that their customers don't utilize the real estate asset like they used to. And the people that didn't catch on to that fell way behind and started to wonder, why aren't customers showing up? Why aren't we getting people? They used to come in steadily, right? And now they're not. And it's because they don't know you exist.
When did you make that decision to integrate all these companies? Because a lot of folks, and maybe you can help folks that are just either starting out or already have a pretty robust company. There's always the question, property management, for example. Do I outsource that? Do I build that in-house? You're a tech company. You could have outsourced that. You could have found a tech company to do it, but you made the decision to keep that in-house and build it. What goes into that decision as to whether to build something out or outsource it?
So this is a great, almost like a great discussion point, because there's a bunch of different theories. So traditional real estate is farmed out into a lot of different pieces, right? So you have a construction guy, you have architects, you have the debt guys, you have the asset management, you have the equity guys, you have property management, you have asset management. Those are all different functions in the real estate world, and everybody does like one or maybe two. And that's just how it works, right? And so people they break it apart and they do that. But in business, we don't look at it like that. We don't, it's like, no, in business, we are trying to optimize through scale, and you're looking at all the counter pieces and how do we lower expenses, maximize revenue. But once again, because people don't look at real estate like a business, they think transactional. Everything's transactional based in real estate, right? It's like, we're going to buy, we're going to sell. If I get more deals, I get more property management fees. So I should only focus on that. Where we looked at, how do we make a better real estate business? Not the assets. How do we make a better real estate business? And when we looked at that, we said, what is our business doing? And how can we optimize, do better, and grow? One of the core central pieces of that was data and integration. And integration, you start to pull data, you can see things, make better decisions, and you can also then start piecemealing and putting out. So the biggest thing that these huge real estate companies have, the biggest advantage they have, is they have data. That's it. Every company in the world is a data company. Every company in the world is a data company. If you're not, someone else is, and you will be irrelevant soon. And real estate's just now realizing that. So what we did is we created a property management system to run all our assets, which we could see our data, but we could also control the functionality. So what people do with tech is they carve it out. I have a property management software. I have an accounting software. Then all of these softwares have to talk together. And what the software gives you is a unit. So here's your one multifamily property. It has 15 rooms. And here's how it's performing today. And you say, all right, well, I can see that. And if you want to ask all this other stuff, it's like, well, you can't get that. You don't do that. You just get this thing, right? What we looked at is if we had all of them together, we could see a bigger picture. So then our management software became a play for us to harvest data, be able to optimize rents and revenue, and also understand in underwriting what actually works. So when we onboard a property, I can now compare it to all other ones. I can see not only in real time how they were doing, how they were going, and then I can cross over what was working, what wasn't. That means I get better at the per unit. So it was a way to centralize these functionalities, but two, to harvest data and use it and make it actionable. And we could do it in a way that the big boys did. We couldn't do it in the way the big boys did prior because we didn't have enough money. So first of all, in order for data to even be meaningful, you have to have lots of it. And by lots of it, I mean vast amounts of it, or it's actually not even accurate, right? So these huge mega companies, even them, they look at it and they're like, we need more. And they're the biggest companies in the world, and they need more to make it even more relevant. So then we thought, we're not that big. I'm not this huge, massive thing. How can we do that? And so what we did is our tech, what we did is we created a licensing and then we licensed it out. So that other people utilize our tech, they get the advantage of something that we built, they use it, and now I get as if I had all of these stores. So now all of a sudden, my tech operates as if it was a big guy because every store that's on it now pouring straight in. And so then what I'm doing is I'm leasing out, right? Or I'm harvesting out the functionality that they took and they had to build and buy, but I can get the best of both worlds. So
I absolutely love that. Hey guys, I've got a couple of questions here, but if you guys, again, idea here is for you guys to ask questions, to drop them in. I see Paula already. Let's go with, I've got a question about investor relations. I know that's and how you structure your deals, which I think is going to be fascinating for everyone, but let's go with Paula first. Paula asks, how large is your optimal plot of land for developing self-storage? Are there some magical size?
Yeah. Generally, so there's two ways you do storage. You do drive up or vertical. Okay. So you go out or up. If you're going up, that can be like 3 acres, right? Now, if you want to build a small, so there's 3 sizes. You have small, medium, and large in storage. Small is anything under 50,000 square feet. Medium is 50 to 100, and then 100,000+ net rentable square feet. So if you're in a mid-sized facility, you need 4 to 5 acres if it's ground floor. But you can build a big facility on 3 acres if you go vertical. You can have like 150,000+ square feet. So if you're building a small one, 2 acres is fine either way. But if you want to get a mid-size or a larger facility that has, hundreds of doors, then and hundreds of doors in storage is not like apartments, everybody. So, if you had, I build storage units for 250,000 net rentable square feet. We have 1,500 doors. If that was applied to multifamily, that's like a $400 million project, right? I mean, that's just ginormous in a first tier market. For me, doing that in a first tier market, it's $40 million. So you have to understand storage is less. So when I say you want to build 200 doors, it's actually, that sounds overwhelming, but in storage, that may be $3 million. So it's not that overwhelming. So a lot of people, they look at going more mid-size. You can build out smaller ones for a lot cheaper. I mean, you build small ones and you're under 1.5, you can build them for 500,000. But that's how we look at it.
Is security an issue? That was another follow-up there is how do you deal with security? And is that something how do you deal with it? Since it sounds
security. So security, the great thing about security is it's really been built out well. It's amazing, our data from camera systems and our locks. So we mixed software with hardware, meaning we do like a no-key system. So our renters can rent from our phone, access gates, everything else like that. They just go in and can use it. What that means though, is I track every person on the property. So the moment they download my app and they're utilizing it to open up gates, everything else like that, I actually know where they are at all times. If somebody doesn't use it, first of all, they'd have to break something to get into the site. And if they do it, we have cameras everywhere. So we can see whoever it is or whatnot, is going in there. And so you do get people to break in. We almost always will get them. But if you have good security, people learn and they don't break in anymore. So our good security locations, we rarely ever get break-ins. because everybody knows you're going to get caught. Because if you use a punch code, I actually know who has the punch codes. So you got to get in, open up gates, everything else, or you're going to cut open and get in, and then you got to go break into a unit. We can see you doing it. And then you got to haul things out. It's actually really hard to do. So, and two, most units are filled with junk.
Yeah, it's it's funny, AJ, when I've got a self-storage up the street, and when I first got in there, first time I went or second time I went, there was somebody ahead of me, and so they put their key in and the door opened, and so I'm like, oh, I'm just gonna. So I followed through, and like literally 3 minutes later, I get a cell call from the owner or the manager, whoever, I don't know if she's the owner or the manager, and she's like, hey, like, oh, it's you, okay, cool, just even if make sure you hit the code, otherwise we're gonna think
Yep.
we can't track you.
That's a big deal. We call it tailgating. Tailgating's not good. So I know you. I know you. We deal with you.
Let's just go right to Tim's question here, because Tim had a question. You were talking about the software and the tech earlier on. Is that something that you built out? Did you hire somebody to build the software? Or did you hire employees? How did you actually build the tech?
Yeah, we went on. So I have 2 tech I'm building right now. I have a software system that does revenue management in our specific way. That right now I have me and a co-founder, and he is building it out. He built out Black Box and bodybuilding.com. And it's just my proprietary system we're doing. We will eventually lend that out, but I needed it to operate at mass, my revenue management system. But the property management system, that was, no, we put money down. 15 mil. Us and partners, and I'm the largest owner and controller of the company, but we have 200 engineers. So 130 of them are in India. And then we're based out of Newport, where our corporate offices are. But yeah, we have very big salaries, millions a month. And we have a full-time CEO, CFO, all of it. It's big. We went all in. So.
Yeah, and I think I know the answer to this already, but I think and I'm getting there. I'm starting to understand this a little bit better now. But when you need something like this tech company or any other businesses, you're partnering with someone. You're picking somebody who can run the business. You've identified the CEO even before you go in there, because you don't have time to be in there day to day. So you're always identifying who's going to actually be running the day to day. Yep.
Always.
I got one question on oversight. I got one question on build and one question on lease up. So let's do that in order. When you do you build all your properties, or do you already buy some and build them and then flip it?
Acquisitions was our main bread and butter. So that's how we got started, because all I was doing is saying, this is a business. They think it's a real estate asset. They're doing a really sucky job. So I'm going to go buy the asset, run it like a business, and then I would just shoot up revenue. I'd refi, get all my money and profits out, and then I'd own it free and clear, and I'd take my money, reinvest it, and I just kept going. So I took what I knew in business, applied it to real estate, and I was able to shoot up revenue. That means I shot up value. That means I could get my capital and profits out quick and do it again and again and again and again. And we did that without investors for a long time. And we built a $150 million portfolio doing that. And so that was our main way we did it. Now, we started doing builds in about 2017. We started to build, and we build and convert. So I bought bankrupt super Kmarts, I turned them into storage facilities, huge ones. I've got an office building that I'm doing right now, turning it into a storage facility. And then we do ground ups. I'm doing a huge one in Phoenix right now. So we do it all. I do new builds, conversions, acquisitions. I try to keep my new build ground up to roughly 20% of the portfolio of deals that we're doing at any time. And then we try to offset more of that with our value add strategy, just for risk profiling on the portfolio management side.
And if you build it, how long does it take you to lease it up? What's the secret sauce? I think everybody thinks it's really easy to do, but when you actually get in there, it's not as easy as it sounds, right?
Yeah, it isn't. And I think we were really lucky because that's not how we started. We didn't build it. Like, a lot of people assume build it and they will come. And that is a really quick way to fail. When I build, like I tell my team, every single door has a person. Don't put a door on that thing unless you can tell me where that person is. I want to know who they are. Do they own a house? How much do they make? Do they have kids? Where are they coming from? How far away? You better be able to tell me where those people are, because then I'm using my marketing to go out and get that person the moment we open up. And then I'm going to go find them all, and we're going to do pre-leasing, and we have a whole thing on how we do it. So my first deal, we leased up to 90% in 3 months. My second one, it was, I think, 6 months, and so on and so forth. In times like this, it's not like that anymore. We were in good times, and we had really good operations. And so we could rock it. But I think now you should plan on 3 full years to stabilize. By the way, we plan on 3 years no matter what, even back then, even when I knew I was going to lease up. And we built products too, though, that were unlike anything anybody had seen. So our first one that we built, everybody told us we were doing it wrong. They're like, this isn't how you do storage. You're building this thing is gorgeous. It's too big. You're wasting space. Like, nobody's going to pay for that. And we had a line went out the door and around, and we had to double staff and everything just to house it, and filled up in under 3 months. But that was because we knew our customer, and everybody else knew storage. I knew my customer. So we really focus on them, and then we build for them, not for us.
What about the on-site management? Bessie was asking, what's the right balance between the tech and the on-site management? Do you have like some formula? Is it one on-site per X amount of units, or what's the right balance there?
Great question, by the way. So we have a lot of stuff that is remote managed. A lot of people say manless storage facilities. It became a very trendy thing. And I was like, we've been doing this for 20 years. We've had small storage facilities don't have enough money to like have a full-time manager in them. So we never used them. What we did is got a third party that would come stop by every week and do lock checks, clean up, all that kind of stuff, right? And it's easier to do that now because of technology. When we were doing it, it was still kind of hands-on, right? I couldn't see a lot of things. We couldn't do a lot of things. Whereas today, through automation, our acquisition and everything else like that is very, very streamlined. And what a lot of the support has moved is to the back office. So I have a sales team, a back office team, and they're helping the front end through the back office. But our sites are generally so big, we do have a manager. And people are like, oh, you could save money with, if you didn't have a manager. And I'm like, this thing is doing $3 million plus a year. Paying a manager $50,000 when you have 1,500 tenants that are driving through a building, like, it's irrelevant, right? But when you get into small facilities, it's the opposite. You can't have a manager. So it's the question is where does that change, right? Generally, we find that under 50,000 square feet, I don't think it's really viable to do it and have a manager unless you're in a really, really expensive area. So if you're in a really expensive area, rents are super high maybe, but even then, under 50,000 square feet, I wouldn't have a manager on site.
We talked about the security a little bit. Josh was asking, in a small facility with no office, do you just stuff all your camera systems and all that stuff in a 5x5, or do you put them on the exterior and the walls and the roof and all that stuff?
So the camera systems that we have, if we do not have an office on site, we have essentially almost like a 5x5 type room. We put all the gear, everything in, we lock it, and then we have our supplies. So we usually do supplies for like let's call it a 10x10, which that hosts all the supplies we need for the site and gear, everything else. Then we have a section or a room that we hold camera gear, electronic stuff, everything like that. But all of it is cloud-based as well. So even though we may have actual records on site, it is cloud-based. So we utilize that.
I'm going to switch a little bit onto sort of more the syndication side. You have a pretty unique approach to it, like investor relations, big on transparency, alignment, all that stuff. How do you typically structure your deals, your syndication deals with investors? Because I think you've got kind of a unique perspective there.
I do things differently. Some investors like that, some do not. Like I like to tell investors, you're not my first priority. Normally investors don't like hearing that, but it's true. They're not. The asset is. If I worry about you and I hurt the asset, you don't get any money. If the asset's successful, everybody's happy. So you are not the first priority. The asset is. And so, yeah, that's how I start off conversations. And so it is kind of unique. So, but it's true. And I see too many people, they let the tail wag the dog. And they are trying to appease investors when they should be appeasing the fundamental economic success of what they're doing, not the person that gave them money, because they do short-term things at long-term consequences. They don't fix things when they should because they want to optimize distributions. They have lower cash on hand. They don't want to tell investors no, where I tell investors no all the time. So I take a very unique approach, but my also other unique approach is they ask, what's your prep? What's your everything? You get everything until you get your money back in profits. Everything. I don't take a split. I call it my investor first model. Why? Because I know I'll make all my money and I'm going to take 50% or 40% or 30% cut at the end. And I know I can do it. So while I say you're not my first priority, you are the first when it comes to returns. So you're not the first priority of the business, the asset is, but you are the first whenever it comes to money or returns. And I'm not second at all. I'm not even third or fourth or fifth. Until you have all your money back in profits, I don't even exist.
Did you start that way, or do you have to kind of build up that track record and trust and be like, okay, well, AJ really knows what he's talking about and now we can pull those strings? Or do you think somebody who's just starting out or doesn't have that track record can pull that off?
Yeah, I don't allow my investors to have any control whatsoever, none. And so I call it a ride along. And I'm like, you don't know what you're doing. So giving you say is actually very harmful because you're not as smart as we are. And if you were, then you go do it. But you're not, so you're coming to us. And two, it's about protecting the other investors. If I gave you say, this other investor didn't invest with you. They invested with me. And so I'm also protecting other investors by doing that. When you're starting out though, lots of times you go to single source. When you do single source investing, that's totally different. So meaning that.
What do you mean by that? What do you mean by single source?
Meaning you have a one check writer. So if I come and I give you $1 million and that's what we need to do the deal, and you say, okay, AJ, but I'm not going to give you any say, I'm going to say, no, I have all the say because it's all my money. You're not protecting any other investors. You're not doing anything else, right? And I think that's fair. So if somebody came and gave me a check for $20 million and that was the total amount we needed to raise, they would get just as much say as I would get on sell, everything else, right? Because it's their money. They're putting it all up. If you're in with a bunch of other investors, that's totally different now. And so we look as, I would never give them say though, under a certain level. So you can't have say anything operationally. You can't have two cooks in the kitchen. Just can't do it. It won't work. And so no operational say, but say on big things. Anything that deals with money, anything that deals with bankruptcy, anything that deals that, and they need to be informed all the time. So I inform my investors just not on reports. I inform them on strategy, exactly what we're doing. I make videos and say, this is what I like about this market. This is what I don't like. Because I say you are an owner, so you need to be educated. I'm not an ATM. And I think investors got spoiled and they started to think that they should get distributions every quarter. And whenever somebody says that, I says, in what world? Have you never owned an asset or a business? You get dependent on the revenues of the asset, and revenues and distributions flow according to performance in different market cycles. You are an owner. You're not an employee, right? And so I'm big on making sure that investors know they're with us, but they are also an equity owner. And if we get in a time of risk, we will put more money in the bank. And we're not going to be distributing it out because occupancy is dropping and rents are dropping. That's not bad. That's smart. And as an owner, they need to think that way too. And they should be thinking that way. And I want them to think that way and not think about it like an ATM. That's really important to me because I'm like, it's not a paycheck. It's not a dividend, right? You are an actual owner. You own equity in a business now. And you should think like that.
Love it. Can you talk a little bit about how you communicate with your investors, sort of those quarterly reports? Because I think that's something I'm noticing, especially, look, there's so many new syndicators. I just don't think they all talk about how to raise capital. That's the sexy part, how to acquire. But then once you actually have the investors in the door, and you have the asset and you're managing your asset managing. Walk us through a little bit about your process of how do you communicate? Do you do quarterly reports, financial reports, videos?
I do
what do you
monthly, quarterly, and I do videos that explain. So once again, I believe an educated investor is a good investor. So I treat them and I call them partners. So I explain to them in detail, this is what we're doing. This is why. Here's what's good in the market. Here's what's bad in the market. And as a partner, here's what you need to be expecting and what you need to understand. And a lot of syndicators actually take a completely different approach. They tell me I'm totally wrong. They say, no, you need to limit what you say. You give them only the bare necessities and they get money and they're going to be happy. And I'm like, but what happens when they don't? And if you don't think that there will come a time when your investors won't get money, you shouldn't be taking people's money. I've been through the great financial crisis. I've been through this commercial real estate crisis. That's not how it works. Like, that just means you had a few good years and you think that it always goes up, and that's dangerous. And so I think that although my style may be different and hard, what I found is people like it a lot more when times are tough. Why? Because I'm like, we got tons of money in the bank. We're doing great. Revenues are going up. Here's our strategy, everything else like that. I'm not giving you money. We want to see this and this and this turn. Your money's growing, your equity's growing. No, we're all good. And they like that way better than all of a sudden when the money stops coming from somebody else and they go, wait, what happened? And then they're trying to explain, we don't have the money in the bank account. We've got to accrue more. And then all of a sudden it's like, well, so are we going to fail? Are we not doing good? Right? It's like, you shouldn't ever come to that conversation ever. They should be a part of it and they should understand it. And so all of a sudden, I think my transparency and my frankness, they actually end up liking a lot. So they go, okay, it's better. And then too, what usually happens is they're like, oh, you started this before everybody else did. You paused distributions. And when I paused distributions last year, I had a lot of investors that weren't happy. And they're like, well, these people never paused distributions. And now all of them are writing us saying, it's the best thing you ever did was pause distributions because market rates fell by 30%. And I'm like, yep, our revenue's still going up, everybody. We're still good. It's all going up. We're okay. We got no problems. And they're upset at the other people because all of a sudden they cut distributions off or they have to make all these big changes. Now they're doing capital calls. Now they're going out for funding. And the investors are left shocked. And they weren't brought along. And so that's why I view my investors as partners. And they need to act like it too, meaning that it's, you're in it like I am, except I hold all the risk. And so it's like, but your money's in this and you're going to get treated the same way I would treat a normal partner. And if you're not willing to do that, I don't think you should be investing at this level of the game. Right. And if you are, then you need to accept what it means to be an owner.
Yeah, and I commend you for that because it's not easy to do that. And when everything's going great and everybody else is putting distributions, that's just a very difficult to hold your ground. So I've always admired that about you. You mentioned the financial crisis there briefly. I know the 2008 crisis, it had a big impact on self-storage, right?
Yeah.
Talk a bit about what happened and why more impact on self-storage versus multifamily or residential or any other asset class.
Yeah, so self-storage is a really weird asset class when you look back as far as performance goes, especially over the last year and then in 2008. And a lot of people don't understand. And that's the big thing. And like in self-storage, like you have investors, right? You have real estate investors and they invest in this, and this, and this, and then you have storage. And we're not real estate investors, we're storage people. It's totally different, right? It's like hotel people, right? Hotel people don't go do other things. All they do is hotels, right? And that's what we are. All I do is storage. I don't invest in storage. I own a storage company. It's very different. And so the problem I think that we got in storage was a lot of people had assumptions and they didn't understand what happened in the great real estate crisis of 2008 because they looked at the charts and self-storage was the lowest defaulting asset class and it had the highest occupancy of all of them. Now, the problem with it is because they didn't actually own or know, they didn't realize that revenue dropped by 50%, but self-storage debts were only like 25% loan to equity. Why? Because banks wouldn't loan on self-storage. So storage didn't have debt. because banks wouldn't give storage operators debt because they didn't like the asset class. And most of them were land plays. And so a huge portion, like 60% of them, had no debt at all. So of course they had a low default rate because there was no debt. And two, we can offset occupancies by dropping our rates, and we can do it immediately. So what happened is we can really boost our occupancy, but that doesn't mean that revenue is up. So we saw a huge contraction in revenue, even though we didn't get a huge contraction in occupancy. So it's not like it was good. It was actually really bad. But because of the low debt loads and because of our ability to just drop rates, like on a dime and give people free rent, which is common, it looked really good to people after the fact. And I think that led up to this idea that it's recession proof, and it's not. And what happened to this last go around was people were buying and building at really high cost. And then when the housing market stalled out, self-storage demand dropped, and we saw rates go plummet. And I think that caught a lot of people by surprise. I don't know why, but it shouldn't have, but it did. And it's been great for us because now we get to buy people that should have probably not been doing it anyways. So good buys, but.
Coming up to the, I promise I get you out of here in 3 minutes. I probably lied. It's probably a little bit more than 3 minutes, but I got a quick question from Tim, and then I want to get your advice for syndicators too. But Tim asked, do you keep a certain percentage of reserves per property or market? And what is that percentage?
Yeah. So, it kind of depends. I like to have operating expenses of quite a long time. Actually, we'll keep around. But say it does $400,000, right? We usually keep reserves around $100,000. We've got reserves in like our fund of like $900,000 in cash sitting there. So we I think we got 20 million plus in cash just sitting there. Which, as far as like to the equity goes, that's not very common. Most people would want to get it out and distribute it to investors. But we're okay with that because we are looking at our physical improvements. It has way more to do with a set. We put 2% of revenues, and then that 2% of revenues is accrued until we hit our maxes. And then over our maxes, we will stop to, or we'll lower the amount of accrual, and then we'll stop altogether. But we're always, obviously, there's always fixtures, things like that going on that have to be done. And so we like to keep those very, very healthy. We do not like to not have cash on hand. And I want operating reserves so we can operate for quite a while without having any problems. And we haven't had any, we've never had any problems. We can have occupancy contract 30% and we're fine. So it is conservative. But I guess I don't think of it as conservative because I guess not only have we been through it, but the money's like, this is the problem. Like, people look at it and they're like, I'm not getting the money. And I'm like, yes, you are, because you own it. So if there's $100,000 sitting in an account and there's 10 investors and you all own 10%, you do have it. The only difference is you have $10,000 instead of $7,000. Why? Because if I would have given it to you, you would have paid taxes in it anyways. So it's not that you didn't get it. You do. You just don't have to pay taxes on it yet. And we're keeping it safe on hand in case it goes. And that's where I get to the problem is I'm like, you're not thinking about like an owner. So if the money's there, wouldn't you rather have it? Because to me, the worst thing ever is if I have to do a capital call. That's failure. If I have to do a capital call, when investors do capital call, that means they had poor investment and cash flow management. And so, capital calls lead to failures, right? And so for me, I'm like, the cash in the account you will receive, right? There's no reason you won't. So whether it's now or in 6 months, as we see different things change, it shouldn't really matter. It's your money, your equity.
You've given a lot of great advice so far, AJ. So last question I always like to ask is just, can you give syndicators some advice? Like, if we've got syndicators on here who have not done a syndication yet, want to do a syndication, or are in the process of it. And then we've got others who have been doing it for a while and want to scale to the next level. Do you have any like sort of general advice for syndicators getting into whatever asset class they're getting into?
Yeah. So if you're starting out, you're going to work more than you're going to make by far. You're going to be vastly undervalued. The money, everybody else will have decisions over you. You are basically getting the opportunity to gain experience, and that's okay. If you do not have experience, don't think you should be paid for it. So if somebody else is paying for your experience and they're going to have say things like that, that's okay. And you should be willing to do that. If not, don't do it. Now, the second thing that I would say is you need to be very strategic, meaning it shouldn't be, I'm going to buy this and the market's going to make it more. Why? Because then I have lots of opportunities. If that's your strategy, now you're just one of a ton of people, right? So then why would I go with you versus anybody else? What do you have to offer? And then what you would have to offer is, well, I'm going to do it for free, right? Instead, have a strategy that others don't have. A strategy that others don't have. So what you're doing is you're offering something. Find a deal, create a strategy, and offer a strategy that they haven't seen. And this can be very simple stuff. It's not big, right? But you have a plan and a strategy that the investor looks at and says, oh, if I give my money to you, I get this. Not give your money and then I'm going to go try to put it to work, because now it's like, well, you don't know what you're doing. You see what I mean? That little thing, though, makes a huge difference. Yeah. Because when you have an opportunity, you also have an ask. In order for you to get this opportunity, here's what I want. It's different, right? So you bring value to the table. And so I would focus a lot on that, your strategy, and act like a business, create a business plan and executing and what it's going to be used for. Be conservative, right? Don't be so conservative that it doesn't make sense, right? I've done that before and that doesn't work at all because I was either scared or something like that, because then it doesn't look like you know what you're doing, right? So you need to be conservative. You need to lay out the ground rules up front. So if you're syndicating, here's my role, here's my responsibility, here's what I do, here's how much I get paid, and here's how much say I have. Lay it out, and here's what you do, here's what you don't do, here's how much you say you have, right? And here's all those things, and you stay in your lane, I stay in mine, and here's how we communicate. Don't assume, spell it out. And start with the divorce in mind. So when you start out, how are we going to break up? That's how you start a contract, because that's all they're used for. You only use the contracts when it goes to crap. So start out with that, right? And if you guys can get through that, and if you can talk with your investors about here's what's going to happen when we fail, you probably do pretty good, right? If you can't start a conversation or get into business with somebody and have a conversation about what will happen when you fail, you shouldn't be in business together.
You know, they call them the operating agreement, but really they should be called the disagreements, because they only really, as you pointed out, you really only look at them once things go wrong. AJ, you're a wealth. I think you've written the go-to book on self-storage, and you put a lot of content. You got a top podcast. Somebody was asking about, what resources do you recommend people checking out? But I think it's a good time for folks to learn about you got a book, you got a podcast, you got a YouTube channel, you got it all. So I think you're kind of a wealth of knowledge in this. So tell everybody about all the places they can find you and get your content.
So we put out, we try to put out a lot of information. I sit on boards, things like that. We work really hard on getting information about our industry out. So YouTube, Self-Storage Income, it's the largest podcast in the world on self-storage, and Growing Wealth in Self-Storage by AJ Osborne. It's the #1 best-selling book in the space. And so we do a very transparent thing. I give my numbers away. We give everything away. It's just, here's all the information. So you go look it up, and we are extraordinarily transparent. And we do that because that fuels, obviously, our business. We get investors, opportunities, everything else. So we tell exactly what we're doing. And it's worked out really well.
Guys, I'm going to stick around a little bit to answer any legal questions you have. But AJ, man, by the way, don't forget, we're co-hosts of the Drunk Real Estate Pod. Don't forget that one.
That's the best one.
AJ always gives us his amazing takes on that. But AJ, buddy, I know you're busy, so I really, really, really appreciate you stopping by and sharing your wealth of knowledge with us. And so everybody give him a virtual thank you, a virtual applause. And
thanks for having me on.
If you'd like to join us live on these episodes and have a chance to get your specific question answered, you can simply go to realestatesyndicatorlive.com and register to be live on the show. Hope to see you then.